So let's discuss the life cycle of a typical company. This is basically the progression of the business over time and is generally divided into four stages: the introduction stage, the growth stage, the maturity stage, and the decline stage. And in case the business is able to extend its life cycle, then these four stages play out again. This is very important for us to understand because when we are reviewing a company for investment purpose, we need to know where the company is in its life cycle so that we can evaluate it accordingly. So let's discuss the first stage, which is the introduction stage. So a company begins its operations usually by launching a new product or service into the market. During this stage, the sales are low and the company focuses on marketing to acquire its target customers. It spends on improving its product and services and launches advertising campaigns to showcase their competitive advantage and value proposition. Therefore, in this stage, the revenue is low, the costs are very high, and the company tends to make little or no profit. So, to think of companies in this stage, you can look at companies that are recently launched and you can see their ads everywhere on YouTube or in cricket matches. There are a lot of them in India, and I'm sure you can come up with some names. The next stage is the growth stage. In this stage, the business experiences rapid sales growth. It optimizes cost and has a strong product or service offering in the market. The revenues go up while the costs are reduced. Thus, the business starts seeing some profit once the break-even point is crossed. A company usually launches its IPOs in the fag end of the growth stage because this is the time where a company may need additional capital to fuel its growth. A lot of startups that have recently IPO'd are all growth stage companies like Zomato, Delivery, Paytm, just to name a few. Now, after this comes the maturity stage. In this stage, the business is very well established in the market and has a solid product and service offering. The sales continue to increase but at a much slower rate. This could be because of market saturation or new competition has arrived in the market. In this phase, the revenues are very high and the costs are controlled and are generally the costs are controlled. Thus, the business tends to enjoy much higher profits. Companies such as ICICI Bank, Hindustan Unilever, Larsen and Toubro, Maruti, Tata Steel, these are examples of some mature companies in India. After that, the final stage, which is the decline stage. Here we see reducing sales while the cost remains fixed. This can happen because of multiple reasons. Maybe the product offering has become irrelevant in the current market scenario, or maybe new competition is eating up into the company's market share. You can look at BlackBerry as an example when iPhone and other electronic companies launched smartphones into the market. So in this phase, if the company is not able to compete, generally the profits start reducing, and the company is able to turn around itself, it eventually leads to its decline. But not all companies decline. A lot of companies reinvent themselves and they extend their life cycle. We'll talk about a few examples here as well. So each stage can last anywhere from a few years to maybe decades also. So it depends on the industry and obviously the company and how it is managed and run. So you need to assess the financials of a company. Now, very important point. So when we are actually analyzing a company, we need to assess the financials of a company based on the stage it is in. Like a mature company showing losses is not normal. A growth company showing excessive profits is also not normal. A declining company showing profit growth can mean that maybe the life cycle extension is happening. So these things we have to keep an eye out for. But first we have to understand where the company is in its life cycle to make such an evaluation. So an example of a life cycle extension would be something like Tata Motors, which has basically spearheaded the electric vehicle revolution in India. It's currently selling the most number of EV cars. Or you can also look at Mahindra and Mahindra, which have completely changed their fortunes in the private vehicle space by launching an array of SUVs which are doing extremely well. So these are some turnaround stories which kind of extend the life cycle of a company, and then the four stages play out again. So let's continue the discussion by talking about a few companies and where they are in their life cycle. So most companies generally come to the stock market in their growth stage for IPOs, and this is where they require additional capital to sustain the growth. So here you can see some recent IPOs that were launched, and these are basically growth stage companies: Paytm, Nykaa, MedPlus, Delivery. Then we have mature businesses such as Tata Steel, Maruti, Hindustan Unilever, Infosys. So these have been around for over a decade or more, and these businesses are still growing, but the rate of growth is much slower as compared to the growth stage companies. So such companies tend to be highly profitable, which is typical of the maturity stage companies, and they have no debt, and they are cash rich. Then we have some examples of companies that manage to reinvent themselves and skip the decline stage by kickstarting a new cycle of growth after many years within the maturity stage. So the automaker Tata Motors is one such example. So with the launch of electric vehicles and many new age cars, they have started to dominate the personal vehicle category in India. Even Mahindra, with the launch of its fleets of new and exciting SUVs, is now unlocking a new phase in its journey. Also, Reliance, a few years ago, moved from an oil and gas to a conglomerate with interest in technology, retail, media, communications, and which has basically fueled the next phase of growth for Reliance. Before we close the topic of cycles, let's talk about the most important one that directly affects every market participant: the cycle of investor psychology. As investors, we are not always as rational as we think we are. Most times, our investment decisions are driven by emotions and not analysis. We buy what our friends may be buying, and we tend to hold on to loss making stocks to avoid feeling regret or embarrassment. We feel bad if we make a wrong investment decision, and we are somehow unable to correct it. These are just some examples of the issues we face and the errors we tend to make. Just like that, millions of investors make millions of buy and sell decisions every day, which could be either right or wrong, and the markets are basically just a reflection of these decisions. So the investor psychology cycle plays out within individual stocks as well as the market as a whole. So let's discuss how things typically play out and where, as investors, we are prone to make errors. Generally, coming out of a recession, we are in stage 1 of disbelief, where we believe that any rally that will happen is most likely to fail. When the rally tends to sustain, we develop hope that a recovery may be possible. With time, as prices continue to move up, more and more people jump on board. And there is optimism all around. Maybe the rally is real. As the sentiment changes, more investors pour in with more money. There is a renewed belief in the markets, and people tend to size up. So there is belief and people want to get fully invested. As prices and profits rise, people get more aggressive. Everyone wants a piece of the action, and people start chasing anything and everything in the market. So it just becomes thrill then, and people buy on margin, and they tell everyone to buy, and yeah, so it's just frenzy. Soon this leads to euphoria. So you might have heard the term that this stock is going to the moon, or this coin is going to the moon. So those are basically that is generally used to describe euphoria. So this is also where the smart money starts to pull out, as they are aware of how the cycles work, and we had discussed earlier also how this cycle works. There is so this is the basically this is the markup phase, and then eventually there will be distribution. So prices dip as supply increases, but people still believe that the rally will sustain and more money is put in by latecomers. So this is where the latecomers kind of join in. As this rally also starts to fail, because smart money is obviously pulling out and prices fall further, people become nervous and anxious and they can't believe that prices can ever go down because all they have seen is this one-sided price action. So these latecomers actually cannot sustain the market, so prices continue to fall, which further leads to denial and eventually panic. So basically this is where everyone begins to sell, and which leads to further fall in prices. Capitulation occurs when people can no longer hold on to their positions and they cannot afford to lose any more money. So this is the stage where basically everyone who had to sell, it has already sold, and there aren't any more sellers left in the market. So prices now tend to flatten out, and people are basically angry as they did not get from the market what they felt that they were promised when the markets were peaking. So in this phase, people generally lose interest and money flow also dries up. This state of depression can last for some time, could be months, weeks, maybe years also in some cases. And then eventually smart money starts seeing value again at these prices, and they slowly and steadily start buying again. And once they start buying, the cycle starts to repeat, and then we see disbelief, which was here. So this cycle kind of keeps repeating in the market. Over here you can see that we have peaks and troughs, and we have expansions and contractions, and this just keeps on going over the years again and again. So stock market is basically like a pendulum. It fluctuates. Also we want to talk about, so basically news and media. So over here you can see it fluctuates, just like news and media like to over dramatize this. So news and media, they play a key role in influencing sentiments further. So they do tend to over dramatize the events as they play out, pushing investors to make errors by making emotional judgments. Thus, it is very important for you to make your own analysis of the market conditions and act independently. So we'll discuss how to do that in the later sections. And over here you can see this quote by Warren Buffett. I think it's by Warren Buffett. What the wise do in the beginning, the fools do in the end. So basically he's saying that what the wise do in the beginning, the fools do in the end. Now we have covered the two topics of market cycles and stock and sector cycles. So we saw that market cycle is directly influenced by the undergoing economic cycle or by any major global event such as a pandemic or a war. So any investment made during a distribution stage in the market cycle, it may not do as well as something that you've bought during the markup stage. Even worse, buying something during the markdown phase and expecting any kind of outperformance is simply not a logical approach. So when the economy is expanding and the markets are in the markup phase, we tend to see outstanding performance by strong companies. Therefore, where we are in the market cycle directly influences the performance of our investment portfolios. We also discussed the sector cycles and the company life cycles. Now, for example, a mature company, which is a market leader in its sector, will tend to perform exceptionally well when the sector is also in the expansion phase. On the other hand, even the strongest growth company will struggle to deliver any kind of growth or results if the overall sector is in a recession or a slowdown. Thus, it is very important for us to understand the stock and the sector cycle as well, as it directly influences the company performance and invariably the performance of the stock price. So now moving on to the next section, where we will cover the third aspect, which is intrinsic value or the company fundamentals.